I mean, just for the sake of journalistic integrity, how about we listen to the CEO, to CEO Evan Spiegel, and what he thinks about things? Because if anyone should be bullish on the company, it should be him. It should be the management team of the company itself. So I will just quote here something that he said in his recent letter, and that's Snap operates in one of the most competitive industries in the world. Our largest competitors are worth trillions, invest hundreds of billions in capital each year, and are being sued for monopolistic practices. We also face smaller, nimbler competitors growing ad revenues faster of a smaller base with leaner cost structures and higher gross margins. And Snap currently occupies a unique position with significantly more scale and engagement than smaller players, but with less scale and market power than our large competitors. Squeezed between the tech giants and smaller competitors on the verge of greatness, we find ourselves in a crucible moment. I suppose it's a bit like being the middle child. We remain under 1% share of a global digital ad market that is growing 13% year over year, which means the opportunity is enormous. And he continues by saying Snapchat is likely one of the largest AI based video and image generation and editing services in the world, with people using lenses more than 8 billion times per day, while the underlying technology continues to commoditize and open source proliferates, the customer relationship is becoming far more important. Our current stock price reflects doubt. At this valuation, there's startup style return potential, but unlike a seed stage company, we're a team of 5,000 serving almost half a billion people every day. That means extreme accountability, every line of code, every sales call, every minute, every day matters. So I would say that's some inspirational quotes for you here. And I mean, he's having a point, but then again, everything we showed in the last 50 minutes just makes me doubt that, you know, startup style return potential is actually materialized for any shareholder in the coming years.
Yeah, I don't think anybody who's been investing in this company for 7 years or longer, if they were in during the private fundraising rounds, wants to hear that they're still at a startup stage. You want to be well past that after 7 years of a public company. So I mean, it's like it's embarrassing, kind of, if you really think about it that way. And you can also hear that Spiegel pretty clearly acknowledges their disadvantages, and also they had a little call out of their AI features, which I see is just a vanity metric, but I'll get off my soapbox. But they say that they're sandwiched between these massive incumbents, and they have a constant stream of upstarts coming against them. And Snap captures only a small share of overall social media advertising spending, making it unlikely for it to catch up with its competitors anytime soon, who just keep compounding at faster and faster rates. And so, in turn, that limits Snap's capacity to invest real cash into its business, both via research and development and sales efforts, which is why they rely so heavily on share based compensation to fund the business instead. And I think they know, of course, how dilutive that is, but it might feel like the best option for them to stay competitive. Paying people in stock is sort of like another form of currency. But there is a reason that once young companies start to consistently generate positive operating cash flows, they increasingly fund the business's operations with that cash and try to rely less on stock over time. And meanwhile, you've got these newer competitors like TikTok that are operating profitably at a scale in China, which can then subsidize their international business, while Snapchat is blocked from accessing the Chinese market. So that is just yet another sort of subtle disadvantage that Snapchat has against a major competitor. And they would probably tell you, look, our average revenue per user is two-thirds out of Twitter and less than a tenth of Facebook's. So any meaningful convergence in those gaps would be a huge tailwind to earnings and then reflect more of the true earnings power of the business, perhaps. But we've talked about that at length now. This monetization gap does not close on its own, and it hasn't. If their platform is structurally less attractive to advertisers, and has been for years, and Snapchat Plus does not create enough value to reverse their fortunes and maybe even is destroying value, then the argument is just insincere. I think it's illusory. And one of the bull cases for Reddit was them closing the gap in average revenue per user between them and all these other social media sites. But they've actually been tangibly making progress and consistently improving their ARPUs and then correspondingly reinvesting those earnings into their ad tech over time. And so just intuitively, I see that progress, and I can also see why Reddit is just a much better place to advertise for most major brands than Snapchat. And that's how you get this differential and results just compounding over time because Reddit, for example, is continuing to improve its business and Snapchat's just treading water.
We often talk about the importance of being a consumer, just a user of the apps that we're talking about. And listeners might know that I'm not a huge fan of Reddit either, but if I go through that platform now, I can actually see the ads, I acknowledge them, and I see that they are important for whatever I'm looking for right now. Whenever I'm on Snapchat, I feel like I don't even see the ads. And that's not because there are none, it's just that they do not seem targeted at all. And actually, they're just disturbing the entire user experience. And sometimes that fact alone is just enough to figure out it's not working well. And one other challenge that Snapchat is facing, and we're not used to seeing this with big tech companies, is that their gross margin is only 52%. And gross margin is basically the most, yeah, basic measure of profitability, just showing how much more you're able to sell your products or services for relative to their raw costs. So with a grocery store, for example, if a pound of chicken costs them $2.50 and 50 cents and they sell it for $5, well, then they made a $2.50 gross profit. And on $5 of revenue, that's a 50% gross profit margin before accounting for overhead costs, depreciation, taxes, interest, and debt, and all of those costs. And the reason I use that specific example is because Snapchat's gross margins look much more like a retail business than a tech company. AutoZone is a company that you've covered here on the show before, and its gross margins were exactly 52% too. But AutoZone's entire business is based on running physical stores, selling thousands of different products, where Snapchat's costs of goods sold should primarily just be the tech infrastructure costs of supporting their app and maybe compensation incentives for top influencers. But other tech companies like Adobe, I mean, their gross margins are nearly 90%. Reddit, for example, they're actually north of 90%. So you're asking yourself, Snapchat financials, they don't even look like those of a tech company. And what would you say is the reason for that? Why is Snapchat so unprofitable compared to the sector in general?
As you said, Snapchat's gross margin last year was a bit above 50%, where a more typical range for most of its peers would at least be in the 65 to 80% range. Hoping for them or expecting them to be at 90% plus is probably not realistic, but still 50% is just terrible for a tech business like this. And the underlying issue though has been there since day one. And so in 2016, pre-IPO, Snapchat did $400 million of revenue, but had $450 million in an accounting line known as cost of revenue, meaning they actually had a negative gross margin. And then when you layer in other costs, the net margin was negative 127%. And that's just brutal. And Snapchat has always been a very, very expensive platform to run and maintain. I mean, that's the takeaway. That's what that cost of revenue means. And so all that time, Snap committed to spend $2 billion over 5 years on Google Cloud Compute, which is no small amount of money. And in their S1 filing for the IPO, they actually explicitly warn that these hosting costs for their servers and platform will increase as the user base and engagement grow. And in their words, may, quote, seriously harm our business if we are unable to grow our revenues faster than the cost of these cloud services. And that is just not an issue that they've really been able to address to this day. And if you compare that to Meta or Google, where each incremental dollar of ad revenue has very high drop through after fixed costs because they've reached such massive scale in revenue. And in Snapchat's case, scale actually can backfire since that scaled user base hasn't translated to a proportionally large revenue base to spread costs across. And instead, the more users there are, the more infrastructure and bandwidth costs there are, capping any of the potential benefits from economies of scale that you would normally expect to see. And so having so many users without better monetizing them is actually ironically losing them more money, in other words. And in post IPO, some quarters showed that Snapchat generated an average revenue per user of just 90 cents while spending about 60 cents per daily user on hosting costs, just so those people could continue to use the app. And all that left is 30 cents per user to cover the operating costs of everything else they do. That doesn't work. And running an app like this that's entirely premised around sharing pictures and videos, which are costlier to store and distribute, they're more data intensive, more bandwidth intensive, versus an app that's more text-based like Facebook or Reddit, even if they also have videos, I mean, it just means that it's going to be inherently more expensive to keep things running smoothly for Snapchat. And that is my very, very gross oversimplification of how this works. But in Facebook's S1, on the other hand, the company had already shown strong profitability just a couple of years into existence and high gross margins at its IPO back in 2012. Meanwhile, Snap was asking investors to believe it could build Facebook like economics despite starting from these negative gross margins we talked about in a very heavy variable cost structure that was just going to naturally be harder to overcome. And so Snapchat's S1 really tries to spin one of its biggest headwinds as a positive. And so what they describe is how global ad spending is very concentrated in the top 10 markets and how over 60% of daily users on Snapchat were coming from those markets, which, quote, gives us the opportunity to grow our ARPU and provides high capital efficiency, as they try to say. But in reality, by 2016, what that really meant was that North America and Western Europe were already seeing decelerating rates of user growth. So the room for growth was clearly in markets like India and these other rest of the world regions that are a lot less profitable for them incrementally when they hadn't even figured out the unit economics for the entire business at this time in their most profitable markets. And so implicitly, they wanted investors to believe that they could continue to go strongly in developed markets while significantly closing the gap in how much revenue per user somebody, let's say a country like Thailand, might be able to generate for them relative to a Canadian or German user. And both of those assumptions aged poorly. And the question to me really was whether investors in Snapchat's IPO even realized that these were the bets they were implicitly underwriting. I would think for many, the answer is probably no, because otherwise it would be hard to justify rolling the dice in this way.
If it feels like we're being too hard on Snap because you're not used to us going 90 minutes against the company, usually we're pitching companies that we like, even if we do not end up investing in them. So if you think we're being too hard on Snap, you might be right. But I just want to emphasize again, we're using them basically as a case study because we constantly come across companies that are just good at selling themselves. And for less experienced investors, and even for us at times, it can be hard to know how to sift through that noise. But you got to build that skill, recognizing that, okay, this is something that actually matters, and here's why, or why some data point or insight from management is more misleading than anything. Basically, what you just pointed out. And there's a lot of reading between the lines in what we do. I think that's almost 50% of investing is reading between the lines, figuring out what something that is said actually means. And that's not to say we're always right, but what matters is practicing thinking for yourself, which is hard. It's not easy to do because a lot of these CEOs and management teams, and I said that earlier, they're really charismatic people. If they're on earnings calls, usually, maybe not in the case of Snapchat, but usually they know what to say and they know how to communicate with investors and to basically sell a story. And they know what investors want to hear and they can make a fancy presentation to deliver that pitch. And I think it would be easy to get lured into thinking that Snapchat is just a misunderstood business, which a huge user base and huge potential in the future. And maybe it is, but from what we can tell, it's as good an example as any of an instance where the setup looks promising at first, and that's why you thought about pitching the company. And it may even looks promising the more you dig in, unless you have a well-refined BS detector.